It's important to understand the following, Liz, that you must do what's best for the client, and every person is individual. You can have two investors side by side. They are twins. They have the same date of birth. They have the same net worth. They're wearing the same suits and drive the same cars. But the end result of what they want from the money is always separate and distinct. So that's the first thing you ask.
Welcome to Local Living Tri-City, your go-to podcast for exploring the vibrant communities of Temecula, Murrieta, and Menifee. Join me, Liz Jones, as we dive into real estate insights and local business stories, bringing you closer to the heart of our Tri-City area. Let's get started with today's episode. Hey everyone, this is Liz Jones with Local Living. Thanks for joining us to this week's podcast. My special guest today is Jason Lund.
Great to be here, Liz.
Thank you. Thanks for being here. With Lund Financial Management. And Jason and I were introduced together probably about, it's almost 8 years.
It's been a long time since we first met each other.
Yeah, we've kind of had our paths cross again. We're both part of a BNI, Business Networking International.
Correct? BNI.
Correct. And so we've had an opportunity to re-engage and talk about some creative strategies to save our clients some money. And I thought it'd be important as a real estate host to be able to bring some of these ideas to our investors. So
I'm happy to help, Liz.
Thank you. Thanks for being here. Okay, so we're going to talk a little bit about the topic when we got together. I have some situations that I wasn't sure how to help my clients, but you came up with a creative solution. So I'd like you to talk to our audience a little bit more. So I have two scenarios I'd like to bounce off of you. I have one scenario where there's a commercial piece of property being sold. They bought it for a song. They put some buildings on it. Now they're selling it to their tenant, and their tenant's been there for 25 years. And there's some money that's going to turn hands, probably about $4 to $6 million turning hands. The owner of that property is moving out of the area. He is in his 80s. So the tax consequence that he might see for an all cash sale, which is what's going to happen, is a big movement of money and a big check written to IRS.
It can be.
So we're talking about that. And obviously at 80s, he doesn't want to do a 1031 exchange, like for like. He's probably not interested in that. So we need a solution for that. The other is similar. So I was presented with a person who came across my path. They inherited, for parents dying, about 10 properties that were all in Hemet, and these 10 properties needed to be sold. He would love to sell them ideally together, but it's not likely going to happen. It's probably going to be 10 different properties, part of this complete estate. He's the executor on this. It's probably $2.4 million of assets changing hands. Obviously, the family would like to have the highest net income from that, and if they're paying a big check, I don't think they want to go back into rentals. Otherwise, they would have hung on to it. So they're another scenario. Is there something out there that can help these people bring them into the highest net?
Well, first of all, it's important to understand the following, Liz, that you must do what's best for the client, and every person is individual. You can have two investors side by side. They are twins. They have the same date of birth. They have the same net worth. They're wearing the same suits and drive the same cars. But the end result of what they want from the money is always separate and distinct. So that's the first thing you ask. On a fiduciary basis, you must know, what do they want to do with the money? Let's take scenario one. Mm-hmm. An older individual wants out of the terrible T's: tenants, trash, taxes, termites, we can carry on, toilets, etc. And what they're looking to do is relieve themselves of that responsibility, and they would like to reclaim what they consider their net worth.
Yes.
And give them a feasible income and a great lifestyle as they carry on to the end of their life. There are ways to do that, but we have to worry about certain aspects of taxation. For example, we depreciate buildings. We use cost segregation. There's a lot of different methodology used because that way the income that's coming to us is going to be reduced, because the IRS says if you're lending or leasing or renting to others, you're going to get a benefit of doing this in the tax code. However, there's a trap in there. All that depreciation, all of that savings you have in costs and cost segregation to reduce your income stream, to take it out of the taxable area, is going to be recaptured when you sell. Unless you decide to replace it with a like building. There is a way around this now. In fact, there are several options, and I don't want to get into the weeds. But let's say we're flying at 40 or 50,000 feet over this particular scenario. He can sell it, and using a specific type of trust and a process that is very feasible within the tax code, have passed muster 29 times under IRS audit, and has been around for almost 30 years now. He can sell, capture all of that effectively tax-infested capital, and place it in a special trust, a deferred sales trust.
What is it called?
A deferred sales trust.
Deferred sales trust.
Section 453 of the tax code. Not that we're going to get into the weeds, I promised we wouldn't, but let's stay at about 45,000 feet here.
Okay.
The money then has not been taxed. The way the structure of the sale occurs is a trustee is involved.
Mhm.
The trustee simultaneously at the point of sale takes possession of the property and sells it and takes possession of the proceeds. Now, what this means is the seller has never taken constructive receipt of the funds. Therefore, all of that pent-up taxation is still carried as deferred. It's deferred still, and because of that, the seller is not obligated to pay any tax on it at that time. Now, the IRS isn't just going to let you not pay the tax. There are some technicalities involved. But ideally, what we're looking at here is an individual wanting to replace income from a fixed asset with income from capital, invested or otherwise, but liquid, correct?
Yes.
Therefore, this trust is effectively taking the capital in, borrowing it technically, and paying it back on an installment note.
I see. Okay.
But
So they get their monthly income.
That is correct. But unlike the risks of a common installment note, where if they default, you may lose your goodwill
Right.
and recover a building or other asset that is damaged, this ensures you've taken all your capital at one time. And the best part is you can structure the installment note so the note rate or the distribution rate is at a point where the hypothetical investment carried within this trust matches what the payment rate is. And therefore, the trust is not being depleted.
Right.
But they're still getting the same or comparable income they were receiving previously, albeit taxable. Remember, we're still at a high level here.
Right.
That allows them to maintain their income stream the rest of their life. But because this trust is effectively paying them debt it owes,
Right.
their inheritors can receive it and keep the same tax shelter through the course of their lives. Or they can break the tax shelter if there's multiple inheritors, break it partially, break it totally. But it's going to be their choice. The structure of this tax shelter can be maintained multi-generationally.
That's great. So you can pass it on to your heirs.
You can pass it on to your heirs. They can make a decision. Now, most importantly, this trust is also allowed to invest.
Okay.
So let's assume this individual says, I'd still like to buy a couple of rental properties. I don't want to invest it all. The trust can take that money
And invest in.
cooperate with this founder of the trust, the originator, who sold the original asset, and they can then invest in new properties if they like, take that passive income from them, still maintain depreciation because it's technically new money. It's not a 1031. We're not carrying depreciation or debt or recapture.
Right.
And because of that, they have the ability to reuse the capital and make it fresh money with an income stream that is then highly tax mitigated.
All right. I got a
If they
couple
choose.
questions. Okay. So I have an asset. I'm selling the asset. Do I sell the asset to the trust, or is the trust just the holder of the money because I sold it to a third party?
We're dealing with a simultaneous activity.
Okay.
The trust is taking possession of this property
Okay.
at the moment of sale.
Okay.
The trust is receiving, as the seller, whatever capital came in to pay
Okay.
for the property.
So there's no maintenance of that property anymore because that's been
No,
transferred to somebody else.
it's done. You have a new
Value of the
buyer.
Property. Okay. That makes sense.
A brand new purchaser. So you're done with it. You've walked away.
Got
You
it.
have all your money.
And now you're getting a monthly income from it.
And keep in mind that if you pay the tax on recapture on a highly depreciated property that is also appreciated substantially,
Yes.
we're in the state of California. That might
Yes.
end up being 40 to 50% of what you receive. This avoids that complex problem.
My gosh.
And it allows this seller to take what is ideally theirs,
Right.
get that higher income stream from it,
Right.
and choose to leave it as a legacy to others.
Now, does it usually the trust have a term? Like, is it a 30-year trust? Is it 10?
Trusts run in 10-year increments.
10, right? Okay.
However, they are renewable.
Okay, so let's say Grandpa puts the money into a trust. He lives through the next 10 years, decides that, okay, now it's time to end it or to extend it for my kiddos. And he does that. He renews that and the
You
trust
renew it.
lives on. And then you can assign a beneficiary to receive.
Yes.
Okay, which is kind of nice. So that is
I,
a legacy product is what that is.
I know this works because I've done it multiple times for my own clients.
Yeah.
And it's an incredibly effective. I don't like to use the word efficient. Efficiency may or may not come to play, but it's effective
Right.
for wealth transfer. And it allows somebody to shed themselves of the tyranny of tenants if they choose.
Yeah.
And all of the other processes involved. Property is something that they're not making more of in this state. There's always going to be a buyer.
Right.
The question is, does the seller want to sell if they don't want to repurchase? And if the 1031 is no longer something they would like to be involved in,
Yeah. And
this
that's
allows
many
them
people.
to bypass that.
That's a great
That is
option.
one option of many.
Hmm.
We effectively can offer 17 options when
Wow.
it comes to these sales, but there are 3 or 4 that are primarily used because they are of the greatest benefit to that seller.
How about a business? If someone wants to sell a business, does it work the same way?
Here's the miracle. Under this section of the tax code, it works for any appreciated asset.
Huh.
It can be stock, a business. I have a client sold a $10 million business
Wow.
with a $200,000 cost basis.
Wow.
This solved a real big tax problem.
Oh, I bet.
I had a client sell a $10 million storage facility. It had just opened. There was no depreciation on it. It was month 1, unsolicited offer. He says to me, should I do this? I said, why, yes, you should. So he was able to claim almost $6 million of his profit and not pay tax on it.
And he'll get that dispersed over time, right? The 6 million will come
Yes.
to him over time, just as if it were any other deal. It's just not, you're not taking all 6 million and sticking in your account and issuing a check out for 2 million.
Correct.
Okay, so it just comes over time and it's
Yes.
still an asset worth 6 million.
Correct.
Okay, and that's important, I think, for people to understand why use a trust in this case. That's creative.
But always remember, it's based on the individual. It's a fiduciary process, and we have to question the individual. It's important to know what is their goal with the money because it's their money.
Right, right. So if we were talking to, say, someone like Brendan, who's in the background here, his age, he obviously wants to wealth build. So for him, a 1031 might be a better product for him.
Absolutely.
Because he's going to get a better house every time he buys up and use the equity or at least the tax savings deferred to buy a better house. But in this case, for people our age, this is a great product for us.
Well, thank you for pointing that out. Yes, because the 1031 is a leverage process to grow wealth as you become an investor and expand your investments in real estate.
Love that.
But you come to a point where you want to not invest, you want to divest. And this allows you to do it in a manner that prevents the insidious and sudden influence of taxation to remove a large percentage of what you've worked for. And the IRS does not mind this when it's done properly.
Mhm.
Here's why. When you have that kind of capital and you're reinvesting it,
Mhm.
the reinvestment, whether it's in stock or new real estate or anywhere you go or a new business, that reinvestment is creating a consistent tax flow to the federal treasury.
Sure.
They go with the long game and they understand it. And if it's done appropriately, it pays them more over the life expectancy of the originator and inheritors than that lump sum would ever pay them. So it's really a win-win situation for the owner, seller, and the federal treasury.
I love that. I love that. Well, I know your business has dozens of things that they offer. I know that we've been in our BNI and so many of those individuals have talked about how you've helped their finances, their savings. Could you tell us a little bit more about some of your other offerings?
Well, I am a fiduciary financial advisor. And my job, when someone comes before me and has a problem or they're trying to plan accordingly,
Right.
my job is to assess what they do and provide to them what is in their best interests. And I do this with a great regularity. And more often than not, I don't even do business with them. But when they come to me on referral, I talk to them. And if there's a problem, I find the solution. I often have been able to tell them, all you need to do is A, B, C, and you can walk out of here and you're good. And if you'd like to come back because Liz referred you and that makes you special, we can talk again in a year or two. You don't necessarily have to hire me. But often people have a problem that requires the acumen I carry and the intellectual property. And that's when I step in as a financial advisor. I do not charge consultation. I do none of that. What I do is if I acquire the funds as capital to manage, I charge a fee. Every other aspect, intellectual property, structure, skill sets, comes from that.
I like it. I love it. So I know that a lot of times there's people like my youngsters and my my kiddos, and it's important for me that they understand that they're young and this is the time to save. How is the best way to save that money over time? Are you able to help people like that as well?
I am working sometimes with the grandparents of my original clients. I've had clients for 32 years. My oldest clients in grade, I've had for 32 years. I work with their children. I work with some of their grandchildren. My goal, and I understand what I do professionally, is a public trust. The more I can teach people to make better use of their capital, the better off we all are. And that's why I love the way we can defer tax, because if someone is deferring tax on a big sale, and that money is kept and not paid to tax, it may be used for charitable contributions, but it stays local and it is recycled locally. It doesn't vanish into what I call the abyss of a state or federal treasury that are consistently in debt to the point it was spent before they received it.
Right, I'm sure.
I firmly believe, not hypothetically, but directly, it's better when the money stays close to home.
Yeah, I hear you. I look at my Social Security collections and I think that didn't go very far, but they've been collecting for me since I've been a youngster. So I have a question for you. It may be outside of your scale, but your knowledge base, I know it's not outside of. So I've always wondered, Roth IRA for someone young or a traditional IRA or 401k? Can you share what is the right way to go on that?
Well, as my mother used to say, that is the $64,000 question. And I just dated myself again. Both have an effectiveness.
Right,
Now, if you are in a very high tax bracket,
right.
sometimes you want to use the traditional
The traditional.
because the tax cost of the Roth may preclude a maximum benefit from it when you start the withdrawal phase. But you don't know till the analysis is done.
Right.
That's the key point. Analyze every single aspect financially now and carry to the future, even to the end of your life, because if you want a legacy, the greatest inhibition on legacy is taxation. We can plan accordingly. But for the younger person, I like to put it this way. You can pay tax on the seed of an apple tree, or you could defer the tax. That seed sprouts and it grows. Both do. One is prepaid, one is tax me later. Now, 25 years later, that 35-year-old person retires and they have a very large apple tree producing 500 to 800 pounds of apples every year. Would you rather have paid tax on the seed or would you rather pay tax on the apples? And here's the critical factor. When you pay tax on the seed, you know exactly what you paid on it.
Yeah.
You have no control over the tax on the apples. Congress changes the House of Representatives every 2 years, the Senate every 6, the President every 4. You have no control over your future tax costs unless you choose to control them by paying in advance. You are paying forward the most applicable way to reduce your future income tax.
That's great.
By using a Roth.
That's great. Now, people who have a Roth or traditional, can that be managed by people like you?
I manage a lot of IRA money.
Do you?
I don't want to say how much, but it is substantial. I manage individual monies, IRAs of all types, trust money, 401k money, cash balance plan, corporate pension money. I've done this for 35 years, and I've assembled a team I have found to be exceptionally trustworthy, incredible intellectual property. Here locally, Los Angeles, in Kansas, in Missouri, all across the country.
That's awesome.
These are actual experts at what they do.
That's wonderful. Well, I heard a lot of great things about you. So obviously you've helped people that I know firsthand. So thank you for doing so. Is there anything that you want to share with our audience before we wrap today?
I think the best thing I could say at this time is plan.
Mm.
You are going to be, if you're 20, you're going to be 40.
Mm.
You're going to wake up one day, you're going to be 50. We will tell you, we're not going to say how old we are, but you might wake up one day and be 60. By planning in advance and planting the seeds, we have a problem in this country. People are spending more time planning for 1 year's vacation
Yes.
than they do for their retirement over 15 or 20 years.
Mhm.
Take the time. Request an analysis. Make sure you're contributing enough. Understand your risk. Know what inflation's going to do, and plan that the income you have later is mitigated in taxation, will keep up with inflation, so you have the good life, because no one wants to work 40 plus years and come to the point where they are subsisting.
Yes.
And I far too often find this out.
Oh, yes.
Pay it forward every paycheck, every week, every month.
Yeah, it's well worth it. That's great advice. That's great advice. Well, everyone, I hope that if you have some financial questions, that you will look at the link below and reach out to Jason Lund at Lund Financial Management. Is there a website they can visit, or an email, or a phone number?
LundFinancialManagement.com, or if you'd like to call me, 619-200-7141. My cell phone is my client's lifeline.
That's terrific. Thank you very much for being here today. I appreciate it. This is wisdom. It will help me as I'm approaching my clients and they want solutions. It will help even our family when my husband comes down to the time where he'll sell his company. And this is a great gift for a lot of us. So thank you.
As my grandmother used to say, sadly, in the end, it's all about the dollar. Handle it well.
Yeah. Thank you very much for joining us at Local Living. Until the next time. Thank you for listening to Local Living Tri-City. Stay tuned for more insights and stories from Temecula, Murrieta, Menifee, and surrounding areas. Be sure to subscribe, leave a review, and share this episode with a friend that is passionate about the Tri-City area as you are. Goodbye for now, and we'll see you next episode.